This is session 16 of our week-long series, Tax Summit Week 2021. This event is pass-through entity taxes at the state and local level. At this time, I'm pleased to turn our call over to our first presenter, Patrick Doyle. Patrick?
Thanks, Allison. Excuse me, and welcome everyone to our session today. Hopefully everyone's been enjoying the Tax Summit all week. I know a lot of the sessions have been extremely helpful for a lot of our clients, getting a lot of positive feedback. So hopefully we'll have the same coming out of today. As Allison mentioned, my name is Patrick Doyle. I'm a senior manager here in our state and local tax group sitting in New York. Joining me today is Dan Klimas. He's a senior manager in our state and local tax group out of Chicago. And also Ryan Corcoran. He is a senior manager in our Washington National Tax Practice. So for today, we are going to be going through pass-through entity taxes. It's been a very hot topic of late, and I know a lot of our clients have been reaching out with questions. So for today's session, we're hoping that you'll be able to identify the various pass-through entity tax workarounds and how they, some of them or most of them differ. And one of the biggest things we're hoping that people come out of here is just, identifying some of the risks and analysis that goes into these pass-through entity taxes, both from a state and a federal perspective. We're actually going to start off today with going through a little bit of the background of pass-through entity taxes, how we've gotten here, states that have currently implemented them, states that are contemplating passing them in the near future. We're going to go through some of the overall general intent of the pass-through entity taxes, some of the thoughts and considerations and some risks from a state perspective, and then ultimately going to go through a lot of the federal issues. So, as we're going through, please feel free to submit any questions. We'll try to answer it as best as we can going through the webcast, but hopefully we will have some time at the end to specifically address anything that comes through. With that, we're actually going to start off today with our first polling question. So do you plan on taking advantage of any of the state's pass-through entity tax elections for the tax year 2021 or 2022? Yes, yes in more than one state, no, or maybe. We'll just give it about 30 seconds for everyone to respond. Well, so we have almost 95%. So we'll go ahead and check the answers. Mixed bag. I'm not surprised that D is the largest answer of maybe. I do think that there's still a lot of open questions on whether it makes sense depending, on your organization, your structure, the type of business and income that you're generating. So hopefully coming out of today, we'll have you'll have a better understanding of maybe taking advantage of some of these, or potentially not. So with that, how did we get here? So 2017, with the Tax Cut and Jobs Act, they placed a $10,000 cap on the SALT tax deduction, which really impacted a large number of taxpayers, particularly in states with high tax jurisdictions. I'm sitting in New York, so I can vouch for the impact that we're feeling. And in direct response to that, in May of 2018, Connecticut was the first state to pass a pass-through entity tax or a pass-through entity tax workaround, as some people like to call them. And it's essentially was a mandatory tax that the entity would pay on behalf of the investors. It would be a tax at the entity level. So rather than the income flowing through to the investors and being taxed at that level, the entity essentially would pay the tax, and there would be deduction from a federal perspective, and then the the residents or non-residents, for that matter, if they were filing, would have a credit to offset their state tax liability. Soon after Connecticut, we had a few states that also came out with their own versions of pass-through entity taxes. We have the list down below: Louisiana, Maryland, New Jersey, Oklahoma, Rhode Island, and Wisconsin. Interesting to note, though, Connecticut was the first state to pass these pass-through entity taxes, and they're the only state to make them mandatory. Since then, the states that have come out with their own versions of the pass-through entity tax have been elective. And in addition to being elective, all of the state tax regimes or pass-through entity tax regimes differ dramatically amongst them. So, and we're going to go through some of that. And so that was in 2018, and the IRS really did not acknowledge or address the workarounds that states were imposing to try to, as it says, work around the SALT cap deduction. And in late 2020, the IRS came out with Notice 2020-75, which provided guidance from a federal perspective on the treatment and the reporting of these pass-through entity taxes from a federal perspective. We're not going to go through all of the guidance, but essentially, the IRS, quote unquote, blessed the workarounds. They acknowledged that they did exist. They acknowledged the intent, and they essentially said that there's going to be future regulations that would be coming out to address them. But in the meantime, they ultimately went through the pass-through entity taxes and the deductibility. So after that, we started off with 7 or 8 states from 2018 to 2019, and then after 2020-75, you could see the floodgates open. And since then, there's now currently 20 states that have actually enacted these pass-through entity taxes, with potentially 22 to 23, maybe even more by 2022. And, in addition to these elective pass-through entity tax regimes, there's already been states out there that have had entity-level taxes in existence. New York City UBT is primarily one of the biggest ones that we see, but other states such as Tennessee, Texas, Washington, Ohio, they've all had some sort of entity tax till now. But, these pass-through entity taxes have been specifically enacted to address the SALT cap. As I mentioned earlier, sorry, go ahead.
I'm sorry to interrupt you. I was just kind of an observation. Are you at all surprised to see more states not enact a mandatory pass-through entity tax? It would seem to be a mechanism that could help ensure collections and really improve from an audit perspective, rather than making it an elective and going through this process of reissuing forms and guidance. I'm a little bit surprised that we haven't seen, given the success of Connecticut, both as a revenue producer, as we'll see later, and just the benefits it provides its residents as well. I'm a little surprised we haven't seen more mandatory pass-through entity taxes.
And I don't disagree. I think, it would probably make things easier from a federal perspective if they were mandatory in terms of the deductibility. But I do think it allows some flexibility. We're going to talk about it later, but, if the SALT cap goes away, or, if it's increased in the future, whether it makes sense to elect into these pass-through entity taxes. So there's that aspect of it from a planning and flexibility perspective. But then also, could there potentially be a detriment to certain investors depending on the state that they reside in, or Connecticut applies to essentially all of the investors. So there's some investors that don't necessarily need the SALT workaround. So I do agree that Connecticut does have some benefits in terms of being mandatory, but I think the elective really does allow some flexibility. But also, we'll talk about it later, it does add some complexity, with operating agreements, special allocations. Is there a different treatment from a partnership perspective versus an S Corp perspective, and how those are treated and how those are reported. So again, I think it's just more of a flexibility, but you bring up a really good point. So So just to give everyone a really quick overview or snapshot of where we are currently from a state perspective, all of the states that are in blue are states that have passed or enacted a pass-through entity tax, and states in light blue being ones that have some sort of proposed pass-through entity tax right now. And I would actually add Ohio on here. It's ever evolving, and Ohio now has something introduced that they might be passing or have a pass-through entity tax on their books. They already have something pretty similar with their composite return, but this would be an official pass-through entity tax. And then Michigan, we highlighted on here, they originally vetoed their pass-through entity tax, and now they're actually revisiting it, and it looks like it might get fast-tracked, and we might have Michigan turning from a yellow or an orange to a blue and have their own version of a pass-through entity tax by year end. So, as you can see, there's already 20 states on here that have them. By the end of the year, there might be 3 additional, and then more to come in 2022. And one other thing I would just also highlight is the states in here in gray don't have or have a very limited personal income tax, so they don't necessarily need a pass-through entity tax workaround. So, if you look at the map holistically, we're talking more than half the states have had something to address their issues or don't need a pass-through entity tax to address their issues. So, again, we were talking earlier, when it first came out, there was some hesitancy from the states, but ever since 2020-75 came out and the IRS acknowledged it and essentially blessed it, states have really been going down the path of trying to come up to give some benefit to their residents, because they're really getting crushed on the federal side in terms of not getting that deductibility. So with that, I know that was a lot of information, but it was really just the background. I really want to get to the meat and potatoes of the presentation and the tent and some issues to consider. So, but we'll first start off with our next polling question, which is, what is the top issue or concern preventing you from opting into a state pass-through entity tax regime? A, still unsure of the benefits or the mechanics. B, investor relation concerns of making the election. C, federal deductibility, lack of federal regulations. D, SALT cap potentially being eliminated or increased, or all of the above. So we'll give about 30 seconds.
Hey, Patrick, while we're waiting for the polling one, there's a Q&A that I think is interesting for you and Dan, and it's, like Connecticut, that does not provide a full 100% credit to the individual. Do you think there's going to be other states that will be start to provide less than a full tax credit for the tax paid by the pass-through entity in an effort to either raise more revenue or maybe offset some of the cost of implementing this, things like that? What do you think?
So I'll go ahead and take that, Dan, if you don't mind. So, absolutely, we are seeing that. Connecticut was the first. They originally allowed a credit of 93.1%, which essentially was a dollar-for-dollar credit, and then they subsequently reduced the amount of credit that you can take to 87.5%. So it's essentially a revenue raiser. Massachusetts just passed their pass-through entity tax, and they have a revenue raiser aspect of it. There was a question with New York when they passed theirs on whether there was essentially a double add back of the credit, and that would be a revenue raiser for the state. And there's still an open question on that. We're still waiting for guidance from the state. But absolutely, there could be a potential of the state getting some sort of benefit from it for allowing the deduction. Ultimately, you would have to look at the facts and circumstances of the client, the investor base, but the thought is that the federal deduction should generally significantly outweigh what the cost would be on the state side. But again, you would have to look at resident credit issues, other things to contemplate. But it's a really good question, and it's something that we are absolutely researching and advising as we're going through with clients. Dan, not sure if there's anything else you wanted to add as we just show the results of the polling question.
No, I think that pretty much covers it. Yeah, it's certainly it's certainly an opportunity for some states to raise revenue or offset costs.
Yeah, and even not from a revenue raising perspective, but also some of the limitations that you have to contemplate. And we're going to talk, I think you're going to highlight a little bit of the California issue with the TMT. So there could be some potential, revenue raiser on that side. Anyway, 46% or 47% said all of the above. I'm not surprised by that. Those are a lot of the issues going on. I am a little surprised that only 9% said the potentially being eliminated, because that's been a very hot topic of late on what's going on with Congress, and Ryan's going to address it here in a bit. But again, hopefully coming out of this today, we'll be able to address or give you some better insight on a lot of these different topics or concerns that we have. So with that, I'm going to throw it over to Dan to talk about some of the general intent of these pass-through entity taxes, and then also some of the considerations to think about as you're going through your analysis.
Thanks, Patrick. Yeah, and so what the general intent of these different pass-through entity tax regimes really ultimately is to provide their residents with a benefit to offset the 10K limitation that they received due to the Tax Cuts and Jobs Act. Originally, I mean, we already went through some of the history, but states did attempt to do some other workarounds with charitable contributions and things like that, and ultimately those never stuck. The pass-through entity taxes, obviously, since the IRS notice last year, has been a workaround blessed by the IRS, and what it's intended to do is subject a pass-through entity to a tax at the entity level in lieu of the tax that would otherwise have been paid at the partner level. So rather than going through your typical withholding regime or a partner having to make estimated payments quarterly, tax is paid at the partnership or S corporation level and is taken as a non-separately stated deduction or an ordinary income deduction or loss, and that benefit then flows through to the owner. And in conjunction with that, the partner or shareholder would receive typically, we have a couple issues with Massachusetts and Connecticut, but typically partners receive a full credit for that amount of tax paid against their individual income tax in that respective state. So ultimately, and we kind of discussed the elective component of these briefly a couple slides ago. This is really providing a flexible, politically expedient workaround for legislators to provide their voters with a benefit that is typically either revenue neutral or revenue positive. So because they're getting a credit, they're not out any, the residents themselves are not out any tax, and the state is still collecting at the same rate. And in some cases, as with like a New York, for example, where you have to continue to make estimated payments, they're receiving a cash benefit up front as well. So they wouldn't be able to refund those overpayments and the credits until ultimately the return is filed. So, while there's a lot of considerations prior to making an election, especially for partnerships that operate in multiple states or have partners that are residents of various states. So we're going to kind of go through some of these general considerations that everybody needs to be taking into consideration before making an election.
And Dan, sorry to interrupt you. Before we go through some of the key considerations, somebody actually posed a question that I thought might be good to go through, since you just talked about the general intent, and it was just, can we provide a high-level example of how this essentially works? And if you don't mind, I'll just give a really, really high, quick overview of what we're talking about from a state perspective, so that maybe it'll be helpful for some of the people. So let's just take into a very high-level, easy example. Let's say you have $1,000 of federal income being distributed to a partner, or let's say partners 50-50. So they're each getting $500. And I'll use New York as an example because I'm based in New York, so why not? And So from a New York perspective, I'm a resident, I'm partner A, partner B is a New Jersey resident. We're each getting $500 of federal income distributed to us. Now, let's say that all of my activity, or let's say 80, or make this easier, 75% of my activity is within New York and 25% is in other states. So now, if I make the election into the pass-through entity tax regime from a New York perspective, I'm a New York resident, so I would include my full $500 of income subject to the pass-through entity tax, and I would pay tax on that. And let's say it's a 10% tax rate. So the entity would essentially pay $50, $500 times 10% on my behalf. And then on the non-resident, you take into consideration only their New York sourced amount. And in this example, it's 75%. So 75% of 500, probably not easy to math, but let's say 80%, right? So I would only bring in 400% times the 10% tax rate. So then I have I'm paying $40 on behalf of the non-resident. So in total, I'm paying $90 to the state of New York, and then on my federal return, I would deduct that $90 as a line one ordinary deduction. So essentially reducing my federal income from $1,000 to $910. And so when it's distributed to my partner A, since I paid $50 on his behalf, they would get a federal line one amount of $450, which is the 500 minus the 50. And my partner B, New Jersey resident, would get 500 minus $40 and would get 460 reported on his federal K1. Now, from a state perspective, partner A, when he files his resident return, will have a $50 tax credit to offset his New York state tax liability. And partner B, as a non-resident of New York, would have to file a non-resident tax return. And when they file their return, they would have a $40 credit to offset their liability, their state tax liability. So assuming no other facts or circumstances, no other income outside of this partnership, you would think that partner A would have a dollar-for-dollar credit to offset their total New York liability, and then partner B, same thing. So from a state perspective, they're in no worse off shape or better shape than, had they not made this. But from a federal perspective, they are now, we're able to reduce that tax that was paid on their behalf. And we're, from a high level, the benefit would be the $50 for partner A times 37% tax rate. Let's assume they have the highest tax rate. And then from a non-resident perspective, the $40 times the 37% tax rate. And that overall is high level mechanics of how it works. But the ultimate question that we're going to be going through, that was a high-level example. That's how New York's work, but we're going to go through how the different states work, and then ultimately getting to Ryan on, is that $90 truly a trade or business expense? What to think about from a 1040 perspective, and then some of the resident credit issues, because, using partner B as a New Jersey example, does the state allow a resident credit for that tax that was paid on their behalf? Sorry, go ahead, Dan.
No, and that's thanks for walking through that example, Patrick. You'll see it's very appropriate for the slide we're on now. Beyond things to consider prior to making an election, or as you're going to make an election, is who can make it. So is there requirements on whether or not there has to be a tax managing partner make the election? Does there have to be a certain number of partners that opt in order to make an election? And then, kind of how and when, or what's the form of the election and when is it due? For the most part, we're seeing most states, particularly for tax year 2021, say that pass-through any elections are effective or made with the originally filed return. That's primarily because most of these have just been enacted over the last year. New York is an exception, where their election was required to be made online. An account had to be set up and an election had to be made by October 15th. Going forward, there will be other election requirements for some states. For example, in Illinois, estimated payments will be required, and to the extent they aren't made, that could potentially throw the election into question. States like California also have a payment requirement by June 15th of 2022 in order to opt into the California election. As we were looking at an analysis on whether or not to make a specific election, you have to have a good understanding of what happens and how each partner is impacted. So as Patrick's previous example that he just went through kind of highlighted, the treatment of a resident partner of New York is substantially different than that of a non-resident partner. Some states, a state like Illinois, for example, their pass-through entity elective tax is computed on the apportioned or allocated income to Illinois on behalf of all partners. It's not, you would not include the entire federal distributive share of an Illinois resident in the tax base, whereas you would in a New York or California. So states differ in the tax base itself. So the income subject to tax is often based on residency in some cases, but in others, you know, your apportionment, your state apportionment is going to weigh heavily on whether or not the making an election is worthwhile. Some other typical considerations, states have a variety of rules on what partners can be included in the tax base, and even which partners may be owners of a pass-through entity in order to make an election. The glaring example here is California, where a partnership cannot make a pass-through entity election if it has itself a partnership as an owner. So to the extent a pass-through entity election could be very beneficial for California taxpayers, there may be a restructuring opportunity here that may need to be considered, because a resident taxpayer may not be able to make an election if there's another partnership that is an owner.
Yeah, one thing I would just add there too, Dan, is you and I deal a lot with the financial services and asset management industry. That'll pretty much eliminate almost all of our clients from being able to take the benefit of the California specifically, unless they do some sort of restructuring to get that partner out of there.
Right, and yeah, restructuring certainly is a potential opportunity that some clients may need to revisit and see if it really does make sense. Some other issues that you need to consider are the rates themselves. They may be graduated like New York, or they may be set like California, who's set at a 9.3% rate. But as we know, California itself has a graduated rate up to 13.3% if you're subject to the 1% mental health tax. So even though you may be included in you may be making a pass-through entity election, the liability of the members and owners may not be satisfied, and estimated payments may still be necessary. Also, there really has to be a thorough examination of what happens at the partner level after an election is made. Notably, in California, as Patrick previously mentioned, the pass-through entity level credit, which in most states is fully either fully refundable or fully creditable, that's not the case for California. So while the pass-through entity, the distributed share of the pass-through entity credit is creditable against the individual tax, as it's currently written, it cannot reduce tax below the tentative minimum tax. And further, the credit itself is not refundable. So it could result in large carry forwards year over year. What we're seeing with some clients is some planning aspects whereby you may make an election one year, and then for a year or two, they may not opt out, or they may opt out of the pass-through entity level tax because they can't utilize that credit, or until that credit is utilized and fully reduced to near zero. One of the flexible options about California itself, though, is that individuals can opt in and opt out. So again, understanding how the elections bind the owners is critical. So if a state some states may have a pass-through entity election that binds all members or all owners to the election, includes their distributive share in the tax computation. Others may be more flexible, like California, where an individual may opt in and out and plan individually on their end. And as we kind of move on here, one of the biggest aspects to assessing whether a pass-through entity tax election would be beneficial is an understanding of the resident credit. States like Maine and Virginia have come out, and there's guidance that it indicates they will not permit a resident credit for a Virginia resident or a Maine resident to claim that portion of tax paid to, say, New York on their individual Virginia or Maine return.
And, this is really where the analysis comes in, Dan, from a state perspective, in whether it actually makes sense to elect in. And, good example, in New York, we had, a Virginia-based investor in several of my clients' partnerships or entities, and it was basically all of his income was coming out of these partnerships, and he was going to be significantly detrimented by these pass-through entity taxes, because even though he was going to be getting a federal benefit on the state side, he was losing out on all of the resident credit that he normally would have gotten for taxes paid to New York, because Virginia was disallowing that. So he was actually paying all of his Virginia tax in addition to having to pay the New York tax, and then he was in a really, really bad position. That is, I would say, and please feel free to correct me if I'm wrong, but most times the federal benefit usually does outweigh when you're in those situations, but there are facts and circumstances that can really demonstrate that investors could be in a worse position, if they were to make these elections. And, going back to one of your earlier points, is sometimes you only need a managing member or a partner to make the election on their behalf, and they don't necessarily need consent from all of the partners, if they wanted to go ahead and make this election. But that's also why we're, advising clients to really talk to all of their partners, all of their investors, to really see if it makes sense to make these elections, because they could actually make it and bind all of the partners to them, but not realizing that it might significantly be a detriment to somebody. So, but
absolutely, and getting the partners' individual tax preparers involved, I think, is critical if you want to do a full analysis. If you're making an assessment at an entity level, it's certainly not going to take into consideration things you're not aware of, right? Partner may have other losses or other sources of income, and that may offset income from one partnership, and ultimately it may not be a beneficial answer for them to make such an election. So to the extent possible, we'd always recommend opening a clear line of communication, especially with partners that have a substantial amount of activity and income.
Yeah, that's a really good point, because you don't take the full partner's facts into consideration. This is a entity by entity, partnership by partnership, S corp by S corp election. So to your point, if the partner does have a significant amount of losses that he's carrying forward, or other things that might be beneficial at the individual level, we can't take that into consideration really when we make the election. So, it's a really, really good point. And, one other thing go ahead, sorry.
I was just going to make one other comment with regard to the credit for taxes paid. Well, a lot of states don't have language that have kind of addressed this, but what we're seeing is those that have passed their own version of a pass-through entity tax, many of them are updating their laws to incorporate a credit for taxes paid for other elective pass-through entity level taxes, such as, in Illinois, for example, they specifically included new language that would incorporate what is referred to as a substantially similar tax. that certainly raises some questions. Of course, it's not defined. But, you know, with conversations we've had with the Illinois Department of Revenue and some guidance we've seen from other states recently, like New York, it would indicate that essentially these states are going to permit credits for most of these other pass-through entity level taxes. Keeping in mind, this is the idea for this is to be a revenue neutral and a beneficial workaround for all their residents.
Yep. Yeah, the last one I really wanted to touch on, if you don't mind, real quick, you know, in the interest of time, is you know, we've been getting a lot of questions of how this interacts with non-resident withholding and composite filings. You know, again, you got to love states, but, you know, it really does depend on which state. And I'll use Connecticut, New York, and New Jersey as an example. They all differ, where New Jersey, you can use their bait, their New Jersey bait, which is their version of the pass-through entity tax, as a credit, you know, to offset withholding liability or on the composite return. But on the flip side, New York, you don't get that benefit. You can't utilize the pass-through entity tax credit on the composite return, whereas Connecticut, you know, it's a mandatory tax. If you're a non-resident of Connecticut and you don't have any other income in Connecticut, you essentially are relieved of your obligation of filing. So, you know, 3 surrounding states, all with pass-through entity taxes, all differ in how they treat non-resident withholding or composite and, you know, allowing credit. So that is another thing that you have to be mindful of, that, you know, if you've historically filed composites, you know, what does it mean with electing into these pass-through entity taxes? And then if you know, historically have done withholding, you know, does the state, if you elect into the pass-through entity, do you still have to withhold? You know, there is still some uncertainty there. And, you know, we can't go through all 20 states on this webcast. You know, we could spend hours on it, but again, another thing that you should be considering when you're making these elections. So,
yep, we've had several clients that don't want to change their annual compliance process to that degree. I mean, they looked at the benefit, and ultimately, no partners would then be, you know, they'd have significant fees for preparing a New York return now, right? So,
yep.
Certainly something to consider, as well as some of the administrative costs with, bookkeeping and making sure the tax is properly allocated amongst all partners.
Yep. So I'm going to move on to the next polling question, because I definitely want to get to Ryan in the interest of time. But before I do, or as I go over to it, I'll answer a couple of the questions that came through. Before today's session, were you aware of the number of state considerations involved in making these PTE tax elections? Yes, somewhat, no, would like more information. You know, a question that came through, Dan, was, you know, are these elections irrevocable? Again, depends on the state. Some states, once you make it, it's irrevocable for that year. But since they are elective, you generally can, you know, make them year after year. But once you do make them, it's irrevocable for that tax year. Some,
That's right.
Very few, I believe, you know, once you do make the election, there is the ability, I think, to change that election. But, you know, that's few and far between. So it really does depend. But there is that extra layer of flexibility that you can, you know, make it year after year if it makes sense one year, but not the other. Give it 10 more seconds. We have 83% responded. Three, two, one. Yes, somewhat, no, would like more information. You know, I guess it really does depend in what state you're located, you know, type of business, type of entity, you know, if you haven't heard it. But again, coming out of today's session, hopefully we're able to answer some more questions, but that you may have. But if not, you know, more than happy to talk to anybody after this, you know, presentation if there's still some open questions that, you know, you wanted to go through. Anyway, so you want to pass it over to Ryan?
Yeah, thank you, Patrick and Daniel. I think the 4.8% on would like more information is the same reason I'm glad I'm a federal tax person. you're overwhelming me with information on each state already. Like, it's this state. If this state does it this way, and this state does it this way, but watch out for this state, it makes your head spin. Me, federal. That's what I do. So
two words: job security.
There you go. So yeah, as Patrick and Dan were discussing earlier, a lot of these, almost all of these state pass-through entity level tax regimes are in response to the Tax Cut and Jobs Act $10,000 deduction cap for individual taxpayers. And there's a few questions going in and say, well, what about what's happening in Congress? And we'll chat about that in a second. And what's going on in Congress and how might that impact this? But I want to kind of go to the background of, well, why are these states doing this now? And it's just an interesting footnote and a footnote in the conference report that legislation stated for the $10,000 cap on state and local taxes, that taxes imposed at the entity level, such as a business tax imposed on pass-through entities that are reflected in a partner or S corporation shareholders' distributive or pro rata share of income or loss on a K-1, will continue to reduce such partners or shareholders' distributive or pro rata share of income as under present law. And so Connecticut was right out of the gate on this and said, listen, we're going to make it mandatory. It's going to go on the K-1. It's going to reduce your distributive share of pro rata income. Like, this is what Congress intended for the $10,000 cap, that if it's the individual, you're subject to it. If it's the entity, not subject to it. And like we said, up until Notice 2020-75, there was that uncertainty as to how the IRS would view these entity-level regimes. In 2018, I think it was, you might recall there were some states that were thinking about, well, what if we provide a tax credit and the individual makes like a charitable contribution to some designated agency or designated charity, and we'll do that in return. And that was quickly shut down by the IRS. They know it's a quid pro quo. The tax credit you're going to receive for that donation is going to reduce the value of your charitable contribution deduction. Like, don't even think about it. And then you had kind of like, well, the IRS shut that down. It's that idea doesn't work. What's going to happen with these elective taxes? Because as we've seen in a lot of the questions, what's the difference between this and withholding? What's the difference? How does this interact with the composite tax? Like, why is there a difference here? But we got the Notice 2020-75, and it provided a lot of answers to deductibility. And it's really important in this notice. It's a very broad notice. It's fairly short. I think it's 6 or 7 pages. We're hoping we get proposed regulations at some point to kind of expand on some of these issues. But it provides that these payments, and the term is specified income tax payment, is any amount paid by a partnership or an S corporation to a state, political subdivision of a state, the District of Columbia, and they call that your domestic jurisdiction. And it's to satisfy the liability for income taxes imposed by the domestic jurisdiction on the partnership or the S corporation. And it doesn't include income taxes imposed by U.S. territories or political subdivisions. And it even goes on to state it's any amount paid pursuant to a direct imposition of tax by that domestic jurisdiction, without regard to whether the imposition of the liability is the result of an election, whether the partners or shareholders receive a partial or full deduction, exclusion, credit, or other tax benefit based on the share of the amount paid by the partnership or S corporation to satisfy the entity's income tax liability under that domestic jurisdiction. And then that payment reduces the partners or shareholders' own individual income tax liabilities under the domestic jurisdiction tax law. And so when we saw this, we're like, well, this is how all these states are modeling their payments. They're imposing the tax on the entity, and there's a variety of mechanisms as we've discussed, the partial exclusion, the credit, how it works. And the notice concludes that the specified income tax payment is not taken into account for the self-deduction limitation. Any specified income tax payment from the notice made by the partnership or S corporation is not taken into account in applying the SALT deduction limitation to an individual who is a partner in the partnership or a shareholder of the S corporation. So easy and straightforward, right? Not really. You'll notice on the slide we have this question of, well, Form 1065 reporting, line 1 or line 13W, and that's on your Form K1. And why we're asking that, or kind of have that as a call out, the notice provides that the specified income tax payment is not a separately stated item of deduction that a partner or an S corporation shareholder takes into account separately. Instead, it's to be reflected in a partner or an S corporation shareholder's distributive or pro rata share of non-separately stated income or loss reported on a Schedule K1. And so typically non-separately stated income or loss is the ordinary income amount. You know, your page 1 of your 1065 that flows them through to line 1 on your Schedule K1. And you look at that and you say, well, there's various types of pass-through entities, right? You have a pass-through entity that operates a manufacturing facility. The entity makes the election, or it's a mandatory entity-level tax regime, and they pay the tax at the entity level. Trade or business income, really, in our view, no question. I mean, that's a trade or business deduction. It all gets blended into ordinary income. It's all blended into line 1 on Schedule K1. There you have it. But let's say you've got an investment entity that doesn't have a trade or business. And typically deductions for this type of entity are reported on line 13W of the K1 as a separately stated item. And that's because it's not trade or business income. It's income, it's an item that's held for the production of income. It's a Section 12 expenditure. But we have a notice that tells us that this specified income is to be reflected in non-separately stated income or loss reported on the K1. So there's some uncertainty there, and there's a lot of discussion between firms and with the IRS and Treasury that there is this uncertainty. You've got on the form it says trade or business income is go here, but the notice tells us to put it there, but it's investment related deduction. Hopefully we'll get clarity on that. There's additional questions as to whether the partnership agreement might need to be amended if there's special allocations of the deduction. Unless each partner is a resident of the state, the deduction might not line up with the allocation of income based on the individual partner's interests. So, you'd have all this income goes into separately stated or non-separately stated, then gets allocated out, and there may be needs for special allocations. And before making these elections, those agreements should be reviewed to determine how special allocations are to be done, can they be done, and determine from those agreements whether if any amendments to your partnership agreement are necessary to account for a special allocation.
And Ryan, that actually goes back to my previous example. If you recall, we had $50 of tax paid on the New York investor and then $40 paid on behalf of the New Jersey investor. So it was a $90 deduction to the partnership, but how do you specially allocate that? Or do you have to specially allocate it? Or is there something in your operating agreement to allow for that? If not, how do you address that issue? So, it's a classic example right there.
Yeah, and another example is in the S Corp world that there was a very recent AICPA letter highlighting this that says, well, what about, a distribution to a non-participating or an eligible pass-through entity owner? Because there is one set of owners that had taxes paid on their behalf and then ineligible owners. And typically, like if that's in the composite type payment world, there'd be an equalizing distribution. But here, the pass-through, the individual who's in the pass-through entity election, that's a deduction from ordinary income on the tax return, and these distributions are distributions that create some oddities, from a presentation standpoint, from a potential maybe second class of stock standpoint, but economically, it's really about the same. And one of the other things we're calling out is the timing of the tax payment. cash versus accrual basis taxpayer. And the notice says, if a partnership or S corporation makes the specified income tax payment during the taxable year, that entity is allowed the deduction for the payment in computing its taxable income for the taxable year in which the payment is made. Makes sense at first glance, but for an accrual basis taxpayer, tax payments may be accounted for under a special method that allows for deemed year-end deduction if the payment's made with a certain time after the end of the year. So is the notice creating a special rule for specified income tax payments, or is the notice more likely simply providing the general rule of taxes are generally meeting economic performance for an accrual basis taxpayer when it's paid, and the timing of the deduction would ultimately follow the pass-through entity's method of accounting. Also, though, that needs to be considered is for a liability to be deductible for an accrual basis taxpayer, it has to have a fixed liability. And many of these elections are not binding until the return is filed. So the question is then, is it payment anyway because the entity doesn't have a fixed liability at the end of the taxable year because so many of these elections are year by year and the tax isn't imposed on the entity until the election's made on that year's original return. There are some thoughts out there and there's some questions, as to whether the entity has a fixed liability at the end of that tax year. So that's the uncertainty on the entity side. And then you get over to the individual side, and there's uncertainty here. You have an individual that receives a K-1 from an entity that paid a pass-through entity-level tax. The tax is reported. It's in line one of the individual's K-1. Doesn't matter to the individual what type of entity that it came from. It could be trade or business income. It could be from an investor entity. Is this reported as income from a trade or business on Schedule E, or as an other tax not subject to the $10,000 cap on Schedule A of the individual's 1040? And you may be thinking, well, this is just a presentation question, Ryan. The individual gets the deduction anyway for federal income tax purposes. Well, maybe. If it's Schedule E, this isn't an adjustment item for calculating the alternative minimum tax, but Schedule A, it is. And so there's, again, uncertainty there because, for a partnership, the general rule is that, a partnership is generally taxed as if it were an individual. And the other piece is, well, if I have an investor entity, this trade or business income. Well, again, the notice tells me to put it in box 1 as non-separately stated. We also have questions about the taxability of a state refund. So if there's a state tax and the individual receives a refund of that state tax as paid by the entity for a variety of reasons, does the individual then have income? It would appear the individual does, as there was the benefit of a federal deduction, but it's interesting because the benefit came from the individual's trade or business income. It wasn't, the same as putting a tax, your state tax is paid on Schedule A, and then the tax benefit rule comes in and says, well, you deducted $2,000, we got a $500 to $100 refund, so if you had done it perfectly, you should have only deducted $1,500, and we're going to make you add, $500 back to your income in the next year. It's not as straightforward as that. So what to do, though, about these entity-level elections from an entity standpoint? Some have been discussing partnerships with just the resident partners in each to simplify things or maximize the impact. And that thought should really be looked at closely, to determine if there are any anti-abuse provisions that the IRS could assert. Patrick, you and I were talking beforehand. There's also potentially state considerations here if you want to chat about those for a minute.
Yeah, the partnerships are really just being created to take advantage of the pass-through entity tax. And the question, is looking at the rules, what does the state consider income subject to the tax? What is considered connected with? Some rely on or defer to the business apportionment rules. So if you're a resident with no real sourced income, is that really considered sourced income or state income under the partnership sourcing rules and subject to tax? So there really does need to be consideration, not just from a federal perspective, but even from a state side, and what it really means to be state source income or connected with in terms of making these pass-through entity tax elections. So,
yeah, thank you, Patrick. And finally, I talked about there's proposed regulations forthcoming, and then we have, whatever you want to call it, the elephant in the room, the 600-pound gorilla. We've got current legislation. Over this past week, since our keynote on Monday with Dave Cotter, the SALT cap deduction has changed 3 times in draft legislation. Started with nothing in the bill about the SALT cap. Then we went with a full repeal for 5 years, 2021 to 2026, with the cap kicking back in for another 5 years, or 2021 to 2025. The cap kicks back in for 2026 to 2032. And surprisingly enough, that was estimated to score as a $150 billion revenue raiser. That didn't even make it really into the text. That was just floated around. And then we got text last night with a cap. Instead of $10,000 of cap, it's $72,500 in the latest draft. Why $72,500, you ask? The JCT score came out today, and from the 2022 to 2032 period, that scores a $2 billion revenue raiser. $1.75 trillion bill, that's nothing. So that number was picked probably because it's completely revenue neutral. Interestingly, though, the provision, as written now, would be effective also for 2021. It's just not in the score. So there could be, 2021 increased limits. And this could change yet again, as Senator Sanders and others want this income cap. $400K, under that, you can take the deduction. Over that, limit the deduction. And so some want an income cap versus a deduction cap. Yet to be seen. But my takeaway from this is, if this were me, I would still be looking at these regimes as an entity. I would still be modeling these out. I would be taking into account the potential changes in legislation. I'd be looking at the impact of the alternative minimum tax. I'd be looking at, what does this mean from, if I take this, this entity level tax, do I lose benefits like credits from a state perspective? And my whole point is, you look at these regimes with your eyes wide open, make sure any election is the right decision. Luckily, many are year by year, so you're not locking into long-term item. Patrick, you want to take it away with the last polling question and wrap up?
Yeah, Dan, we didn't get to discuss it really at all, but one other interesting thing about these state pass-through entity taxes is some are actually tied to the SALT cap, right? So some of these the question is, do these go away, right?
That's right. There's some of the legislation is tied directly to the federal legislation, and to the extent there is not a limitation, then they would seemingly go away. Others have set a date that ties to the 2025 sunset, and others are silent. So we're again another thing to keep an eye on. And unfortunately, as Ryan previously mentioned, these are almost all year by year elections. So there is flexibility.
All right, guys, that's it. I know we're come down to the wire. Please answer this last polling question. We're going to switch it over. Allison, if you want to take it away.
Sure thing, and thank you to our presenters today and our audience for joining us as we wrap up Day 4 of Tax Summit Week. We have one final polling question you can answer while we're closing out today's webcast. A reminder that you can download your certificate by visiting the Certification Center and clicking the download icon. We also invite you to return to the networking lounge where you can chat further on this topic with these presenters. Of course, we've got many other options available for you in the virtual environment if you haven't been checking those out throughout the week. We have the Tax Resources Library, of course, with a wealth of information for you. Tomorrow's webcast will be wrapping up the 5 days of our Tax Summit Week. Our sessions tomorrow are what healthy SALT revenues and state budgets mean for 2022 at 10:30 Eastern Time. We have Canadian income tax in 2021 and 2022 at noon Eastern Time. Planning during uncertain times, tax trends and issues affecting individuals and business owners at 1:30 Eastern Time. And our final session tomorrow at 3 o'clock Eastern Time, full speed ahead, year-end tax planning. We hope you've enjoyed day 4 of our Tax Summit. We look forward to seeing you tomorrow. Thank you very much and have a great day.